Hello and welcome to the second episode of The Market Lens. I'm Sam Rozzi, the manager of due diligence at American Portfolios, and I'm joined here by Cliff Walsh, our chief investment officer. If you haven't checked out our first Market Lens, please do that. It is currently available on YouTube or Studio 454. Today we've moved to the virtual format, but we're hoping for this to be short-lived, and we're hoping that the next recording will be back in the AP studio. Today's news or noise segment will focus on the new infrastructure plan. Currently, there is a $2 trillion infrastructure plan in the Senate, and right now it may hinge on the tie-breaking vote of Kamala Harris. Cliff, do you believe this plan is news or noise?
I think it's definitely news. I don't know if it's going to get done, but that doesn't make it noise. I think it's big enough and it's impactful enough that it has to be news, especially with the potential tax implications.
Yeah. So what actually does this plan look like when you dig into it? I know people on the other side of the aisle are saying only 5 to 10% of it is actually investing in bridges, roads, ports. What actually is inside this plan?
Well, that is true. Traditional infrastructure is less in terms of the total amount of dollars spending than it has been in previous packages. We're looking at about $1.7 trillion over 10 years in physical capital and R&D. A lot of that R&D is going to be focused on technology-related spend, given that we have so much invested in Wi-Fi and clean energy. The criticism is not exactly accurate. However, there is about $500 billion that's going to go to workforce incentives and Medicaid benefits. I did discuss this at our conference last week, the virtual conference. Not everything's going to be spent on infrastructure. There's going to be poor projects, and I think there are going to be issues that people have with this. That being said, I do think it's infrastructure heavy at this point. It's going to have an economic impact. I don't think it's going to be huge on an annual basis. I think in the first couple of years of the plan, maybe we're talking about 0.5% of GDP growth a year. Maybe 3/4 of a point at full ramp on an annual basis. We're going to have to see if they follow up with something more. I think compromises are definitely going to be made on this, infrastructure bill. So what the plan ultimately looks like is a bit of a guess. I don't think they're going to get a ton of Republican support on this, though. Especially with how it's going to be paid for.
Yeah, I would agree. It seems like there are a lot of social impact type programs that are in here, like you discussed with Medicaid, and not as much tangible structure for public common use as, say, more traditional infrastructure. But with that being said, I do think this can make some economic impact. But more importantly, how do you think this is going to be paid for? Do you think there will be a corporate tax increase? Where could the government come in and offload some of this expense?
Well, it was originally looking like it might be a gas or a mileage tax, but now it is looking like it's going to be much more of a corporate tax. I think we're going to see it in three different areas. I think we're going to try to see a push to a 28% corporate rate. Not sure we're going to get fully there, but this is what President Biden proposed during his presidential campaign. Each percentage point of corporate tax rate increases, raises a little over $100 billion. So over 10 years, that could be $1 trillion and covering roughly half of the proposed spending bill. If you say they don't get all the way there and maybe they get to 24 or 25%, then maybe you start talking about 700 or $800 billion of the plan, maybe a little bit more than maybe 40% or so getting paid for by this corporate tax rate. But I think we're going to get into some resistance if we start getting above the 25% rate. Second would be, I think, a 15% minimum tax on corporate book income, which is reported to investors. I think, a lot of times you see companies report large profits to shareholders, but no profits to the IRS. So the government is likely going to, put a check and balance, in there and try to generate some income from that as well. And then third, I think, and least likely to have a huge impact is the tightening of the GILTI tax. And basically, what we've seen from the Biden campaign, it's going to be similar to his proposal, which was to raise the effective tax on the global intangible low tax income. And that would probably go to a rate of about 21% from about 10.5% today, so doubling that tax. And I think there would be some changes to how they go about it. I think they would move to a country by country system that would keep companies from using tax credits from high jurisdictions to offset GILTI earnings in low tax jurisdictions.
Interesting. So a lot on the corporate side. Any prediction on the personal side? What about capital gains tax? What about salaries? Do you think that personal taxes will move up at all with this plan?
The president's agenda does include those, increases, but I don't believe it's going to be related to infrastructure. I think if you look at this particular package, it's going to be focused solely on corporate tax increases. I think the president and his administration are going to save capital gains taxes, individual tax changes for future proposals, probably dealing with healthcare, education, and maybe even childcare.
Okay. So if this bill goes through at least close to its current form, what themes, what sectors, what traditional areas of the financial markets would stand to benefit? What areas do you think would be hurt a little by this? Where would you invest if you had the open capital to invest right now?
Well, the opportunities are definitely going to be more broadly based than the typical bricks and mortar opportunities, but the traditional players still apply. Engineering, concrete, cement, aggregates, pipe companies, they're all in play. But we're also looking at high tech areas. You've got broadband, clean energy, storage, grid upgrades, and even electric vehicles, which are expected to get a boost from money going to charging stations. So a lot of stones for investors to look under here.
Thank you, Cliff. That wraps up our news or noise portion, and we will now zoom into the market lens. The market lens will focus on the market sentiment. Right now, we are looking at both consumer sentiment as well as investor sentiment in the market. Looking on the consumer side, the Michigan Consumer Index has recently ticked up pretty significantly, where numbers surprised to the upside at an 85 versus a 83.6 expected number. We also saw AAII polling data, which is looking at investor sentiment, separating the bulls from the bears out there. And we're seeing more and more increasingly bullish sentiment coming from that end. So, do you think that this is a little bit contradictory towards what we talked about for the bad metrics on unemployment, or what do you make of these sentiment numbers, Cliff?
Well, I think you have to separate the two. I think you have to separate the consumer from the investor. The consumer is rightfully so very excited about getting back into the world and spending. They spent, a year plus, not spending. The economy, was shut down. Now we're back to 70+% open, and it's increasing every day. We got through the winter months where people weren't doing a whole lot from an activity standpoint. So they're excited, and that's good for the economy. And we're going to see, probably a multi-quarter, boost in spending because of it. So there's nothing wrong with that. On the investment side, I think maybe perhaps things have gotten a little bit overheated. If you look at the AAII investment sentiment survey, polled 23% of advisors were bearish. That's nearing the low end of a 15-year band. You've got the spread between the bulls and bears, which widened, to more than 30%. It's a level that's reached that only twice since 2015. Not to mention bullishness above, pre-COVID-19 highs, and these levels were reached just prior to the early and late 2018 corrections. With this poll, we've got 2-to-1 bulls to bears, while the most recent Intelligent Investors poll shows 3-to-1 bulls to bears. So both are near the upper bands there. So sentiment is no doubt bullish here. I think the contrarians and the tactical players out there should take note.
Okay. Do you think that this bullish sentiment is driving more IPOs, more launches of the SPACs? We saw many SPACs gain a lot of assets in 2020, and I think that trend is continuing. Do you think the sentiment is driving those areas of investment and those areas of speculation as well?
Yeah, I think we've seen the rage of IPOs and SPACs specifically, significant increase in retail participation in the markets, GameStop, and all the craziness with Robinhood. But I think SPACs should be a concern with anyone who knows history of what markets like this, from a speculative nature look like. It raised almost $100 billion in 2021, soaring past last year's record total. Accounts for almost 70% of all IPOs this year. So it's clear we have a lot of momentum in these risky segments of the market right now. With all the fiscal spending adding fuel to the fire, I think there's definite reasons to be concerned about how bullish things are.
Understood. And changing gears a bit to the fixed income markets, we're seeing spreads tighten very significantly, specifically after COVID, and you're seeing that trend even continue now. Do you think this is also related to sentiment, and do you expect this to continue?
Yeah, look, well, I think it's coupled with a couple of issues. One, in the search for yield, people are looking wherever they can get it, and high yield is a place where you still can get some yield. The spreads are very, very tight and not overly attractive from a valuation standpoint. But I do believe that the sentiment is driving that as well. We've seen it in the weakest balance sheet companies. We've seen them outperform in a dramatic way. I'm talking, B rated or worse. From an equity perspective, they've outperformed the higher quality companies by almost 50 percentage points in the past year, and 20% in the first quarter. So, they're commanding, a huge premium, 20% to the market multiple right now. And the firms with the most solid financial positions are trading at a 10% discount. And I think the money losers of the Russell 3000 were up 25% in Q1. And they outperformed the index by 5x. So, yeah, we're seeing a lot of sentiment drive, pretty heated, activity here. And it's not just IPOs, and it's not just weak balance sheet companies. The zero earners or the non-earners, are doing it as well. I think the share of publicly listed tech companies that generate zero earnings has risen to 38% of the market. That's above the 36% bubble peak we saw in 2000. And there's over 360 tech firms with a 15 times price to sales multiple, which is also a new high. And these stocks have outperformed year to date. So, it's a very, expensive market. We are going to see the economy, grow at a rate that we haven't seen in a long time. But I think once stimulus kind of peters out and people get back to normal, it's not going to be that long lived.
Agreed. And you've seen some of the tide start to switch over to value, but I think that could be related a little bit more towards the search for yields when we saw the treasury rates moving up and ticking up. That tends to be usually pretty bearish for the growth end of the spectrum. So I don't know how much that ties into the sentiment piece, but what do you have any closing thoughts that could tie up the market sentiment that we're seeing right now?
Yeah, look, I think quickly on value versus growth, I think it's a combination of the reopening and people getting excited about the economy. When growth is scarce, growth companies, perform better than value. So now that growth is becoming more widespread in the economy, value is going to tick up. That's coupled with a very steep yield curve, or relative to where it's been the last couple of years. So, that sell-off in duration has helped value. Just summing things up, I think that just like evaluation sentiment is not always a great short-term timing tool, but we can't let it discount what it's telling us. There are definitely some abnormalities in the market right now. If you're out there and you benefited from the IPO craze or the junk rally, might be time to start thinking about a shift to quality. And if you've been more cautious, I would say stick to your guns and don't chase, some of these really, momentum driven and, low quality areas of the market that have gotten really heated.
Very informative. Thank you, Cliff. Learned a lot here today. And thank you, everyone who joined us on this second episode of The Market Lens. We're hoping that this is helping you see 2020, and we hope that you join us again for our third episode in the coming weeks. Thank you very much, and look forward to chatting soon.
Thanks, Sam.